We're using a new strategy, and it is called a quick fly. So we thought we'd go out and go into the playbook once again. In the structure, you buy one put and sell two lower strike put, same expiration. But to protect yourself, you then buy one even lower strike put. Now you want the stock to go to those two strikes that you're short. You should know that some consider this to be a low probability trade. All right, Mike, walk us through the exact strikes and expirations.
Sure. Well, what I'm taking a look at specifically is the April 175, 160, 1.5 put buy. What I'm going to be doing here is buying one April 175 put, paying $9, selling two of the 160s against it for $465. So I'm 30 for that there, and then going out and buying one of the 145 when I was looking at it. Granted, the stock was maybe a couple bucks higher than it was when it closed, so you're going to be looking at prices around there. The nice thing about a trade like this is the amount of premium I'm putting in is the amount of risk. That's what I've defined right there. In a market like this where we've sort of suggested that there is some risk, I don't like being net short options. That's one of the risks, although I will say that some might suggest that getting long down at that 145 level or lower might not be such a huge risk. But the nice thing is that if it runs right to those short strikes of 160, that's where I'm going to see my maximum payoff. A lot of option traders will say, though, that this is a thread-the-needle kind of trade. You're not only picking the stock's direction, you're picking its magnitude, and you're picking its timing. That's a lot of things you need to get right. But the good news is, spending less than $2 to try to make this bet, I'm not risking a whole lot. Stock was down almost $5.
Yeah, listen, Michael, you are threading the needle with this trade. There's no doubt about it. It's a tough one because you got to get all those things correct to actually make that money rather than some other structures like we talked about the tree. You just got to get it in kind of a wide range. It's kind of like throwing the football, and getting in the barn door or something like that. So at the end of the day, you got to have an inclination here. You got to have a bearish view, and you got to really nail it.
I know there are a lot of strikes in this trade. It can be confusing, but if you can bear down, these can be great strategies, these flies. The only problem with Amazon is that by going out this far, he gets into options that are not particularly liquid, so the bid offer on each of these can be a little wide. All that means is you have to be really careful when you do your execution.
Well, the truth is you're not likely to take it off because, paying bid-ask and 4 names and the commissions is going to be an awful lot.
Yeah, that's true. Although these spreads in Amazon, given that the price of the stock are actually relatively tight, it is an actively traded name. Most of the people who are watching probably already recognize that. And the other thing is, I couldn't go out and short this stock. This is a stock that's been up 27% after some earnings when they really have blown it out the door. And it is a growing company, so who knows how people...
You can't short the stock where you're confident that you can thread the needle.
Well, the big risk, though. That's the big
right, that's true.
Yeah, the big difference is if a lottery ticket costs $1,500, I might not buy one. But when they cost $1, it's all right.
I'll make one point real quickly. This is a stock where people have been trying to separate the valuation and the fundamentals for as long as it's been around, as it's been a public company. And it hasn't really worked. So at the end of the day, this is not one that you want to continually make these sort of bearish bets on. You're going to end up losing in the long term.
Okay, one more time for good luck. Stocks versus options. Shorting Amazon, well, that carries unlimited risk. It's been pretty painful for anyone who's done it in the last year. But Mike's put fly only risks about $30 and offers huge leverage to the downside. All right, of course, our thanks to Carter Braxton Worth up on